When looking at investing in hyper-competitive, commoditized industries, investors look towards companies with a strong track record of execution. Lightspeed Commerce has a history of failure and will struggle to compete with this new turnaround strategy. Good afternoon, judges. Today we get a sell recommendation on Lightspeed Commerce with a 28% downside to last Thursday's close. From our proprietary research talking to industry experts, including senior executives at competitors such as Fiserv and Toast, alongside former Lightspeed executives, and serving merchants and consumers, we strongly believe Lightspeed still has downside for three core reasons. Firstly, Lightspeed has a history of destroying value. Second, their top-line growth is challenged as the industry matures, and it has a weak sales force. And finally, their new growth strategy targets a worse customer.
Lightspeed sells point-of-sale systems. To provide an example workflow, cashiers would first enter transaction details, customers would pay on a terminal running Lightspeed software, and then Lightspeed processes the transaction. However, they only collect roughly 40 basis points of every transaction after paying for third-party networks like Visa and MasterCard. They also sell software modules for functions like inventory management. These software modules consist of their subscription revenue, and they also collect transaction revenue from fees charged on payments processed through their platform and fees from Lightspeed Capital, which is their merchant loan business. The last revenue stream is from the sale and installation of hardware. Over the past 5 years, Lightspeed has traded down, first mandating that customers adopt Lightspeed payments, resulting in a shift to lower margin payments revenue, then lowering guidance as management failed to execute on their strategy. Turning to how the industry has performed over this period, we can see that Lightspeed consistently lags behind peers. This is shown by the rule of X, which adds revenue growth and EBITDA margins to assess the growth and profitability trade-off. In 2020, while peers were focused on integrating payments, boosting EBITDA margins, Lightspeed was focused on M&A, leading to one-time revenue gains. Lightspeed finally launched Lightspeed Payments in 2023, by which time competitors were focusing on ramping up outbound sales, and Lightspeed has only now just begun to launch their own outbound sales force, leaving them behind in both EBITDA margins and revenue growth. Taking a deeper look at the companies included in this peer set shows that the industry is consolidated. In order to determine what differentiates companies, we conducted 52 customer interviews. We found one notable emerging customer need was being able to run all of their operations out of one POS system, which is a partial motivator behind their past destructive capital allocation.
This brings us to our first thesis, that Lightspeed's historical capital allocation and expansion strategy has resulted in the destruction of value and a structurally weakened product today. This is clearly reflected in Lightspeed's negative ROIC, which has increasingly lagged peers since 2021, with peers such as Block and Toast recently achieving positive NOPAT. Meanwhile, Lightspeed has been unable to achieve a comparable or even positive ROIC despite implementing similar profitability strategies as peers, such as layoffs. A specific example of Lightspeed's poor capital allocation is their inorganic growth, including 7 acquisitions completed between fiscal year 2020 and 2022. These acquisitions were completed with the goal of entering new geographies and new verticals. However, as shown here on the left, these acquisitions were completed at very high premiums relative to other similar transactions that occurred around the same time. Performance since has not indicated that these high prices were warranted, with recent divestitures of acquired companies revealing significant declines in customer locations and enterprise value, implying an overall return to Lightspeed from one of these acquisitions of only 0.2x. In addition to the destruction of acquired value, this previous strategy has resulted in a structurally weakened and more expensive to maintain product today. In the past, R&D has gone towards integration of acquisitions rather than new margin and top-line expanding products. As a result, R&D efficiency is lower. Even as Lightspeed completes this multi-year integration, engineering experts have highlighted that Lightspeed's codebase will continually require more maintenance as opposed to peers that have primarily grown in-house, such as Toast. As a result, this translates to $270 million more total R&D spend in our model over the forecast period and a 3% hit to EBITDA margins.
Lightspeed will struggle to grow top line as the industry mature, and Lightspeed has a weaker sales force. Historically, the industry has grown as merchants migrated to the cloud, leaving legacy POS systems behind. However, there's limited white space remaining as majority of merchants in North America are already on cloud POS systems. That leaves the only avenue to grow locations is taking customers away from competitors. However, from talking to merchants, they note they have little interest in switching cloud POS systems as the switching costs are simply too high. Additionally, Lightspeed will also struggle to grow top line due to its small and weak sales force. As shown on the top, Lightspeed has the smallest sales force in the industry as they were the last to adopt outbound sales, meaning peers can cover more ground and convert more customers than Lightspeed. Additionally, the efficiency of these sales reps is subpar, as shown on the bottom. For each dollar of sales and marketing that Lightspeed invests, they see a decreasing return in terms of subscription gross profit, meaning sales reps are unable to convert customers and monetize them effectively. In order to meet guidance, Lightspeed will also struggle due to its sales force. As shown on the top left, Lightspeed, taking the low end of Lightspeed's customer location guidance, they would need each rep to bring in 45 to 70 customer locations. We view this as hard to achieve, as historically both Toast and Lightspeed sales reps only bring in 40 locations each year. So, in order to meet guidance, they will simply need to grow their sales force. However, to meet the low end of their guidance, they would need to double their sales force by fiscal year 2028, which would have a significant drag on margins. In our forecast, we take a 3% haircut to management's location guidance and grow locations at 7% through fiscal year 28.
Our low conviction that Lightspeed will be able to succeed is further supported by their strategy's target mix, which is margin dilutive. As part of our analysis, we scraped over 30 assessments that ranked the best POS systems for businesses and found that Lightspeed lacked a clear winning segment from the small, medium to enterprise spectrum. Customers consistently prefer competitors, which we see in their decelerating customer locations growth rate as they have failed to find a proper niche. As a result, Lightspeed is now focusing on the one positive area their customers do highlight, their inventory management system. They're doing so by targeting physical, inventory-centric retail merchants, such as department stores. Consumers, however, have been moving away from these verticals, which we see both in declining department store sales data, as well as our own consumer survey, where most people said that they expect to either maintain or decrease physical retail spend in the near future. Meanwhile, as they pursue the structurally capped strategy, their mix shift actually becomes unfavorable to margins. As Lightspeed targets these larger customers with higher gross transaction value, as you can see on the right, these customers pay structurally lower fees because they have greater bargaining power. This is part of the reason that the percent of each transaction Lightspeed retains has declined from around 80 basis points to now 44, sits far below all their peers, and is structurally capped as they also own less parts of the payments value chain. Taken together, weak positioning, challenged end markets, as well as a negative mix shift, we see downside risk to both growth and profitability. As part of our analysis, we also looked at ESG. We created a proprietary scorecard using a mix of external methodologies as well as expert calls, assessing Lightspeed against a variety of variables as well as their peers. The reason we did this analysis was to focus on an area key to their strategy, governance. Historically, Lightspeed's management has destroyed value, which we see in their stock price. Lightspeed is currently run by its former founder and CEO, Dax da Silva, who initially left the company in 2022 but was reappointed by the board as interim CEO in 2024. Looking at the board, they lack payments expertise compared to peers, which we believe, coupled together, elevates execution risk that has been factored into our model. Looking at compensation, we can see that management is paid using metrics that measure growth and adjusted profitability, but they lack any measuring any sort of returns, which we believe creates misalignment with long-term shareholder value, especially given their poor ROIC history.
Now we'll take a look at our valuation and some of the risks associated with our theses. Overall, our valuation resulted in a final target price of $7.11. This is based on a weighting of 20% on our relative valuation and 80% on our intrinsic, which is split 50-50 between the multiple and terminal growth methods. First, taking a look at our relative valuation. As you can see at the top, Lightspeed has consistently traded at an over 60% discount to its peers based on EV to gross profit. This is because their structurally weakened business has resulted in persisting worse economics as compared to its peer set. As a result, we've applied a 60% discount to the forward peer multiple used in our valuation. Now, taking a look at our intrinsic, where we've modeled a view that is largely in line with consensus except for two key areas. The first is slower customer locations growth in our revenue build due to low conviction in future growth to Lightspeed, as outlined in Thesis 2. The second is a slight contraction in gross margin due to the poorer economics associated with their shift to payments and higher GTV customers. To further validate our valuation, we developed different cases to understand what potential further downside and upside would be to Lightspeed. We saw that there is only limited potential for upside to Lightspeed, even if we were to assume aggressive improvement in EBITDA margins.
Through our presentation, we've addressed the risk that the core growth strategy and payments profitability will not pan out. However, there is still lingering belief that Lightspeed may be acquired. However, earlier last year, the business was put up for sale, yet no buyers emerged. This is because competitors can go out in the market and and acquire customers at a much lower customer acquisition cost, either through outbound sales or acquiring better POS competitors. Thus, we believe Lightspeed will not be bought out. All in all, given Lightspeed's history of destroying value, its top line being challenged as the industry matures. Thank you.
Can you share some of your assumptions on the payment penetration system, payment penetration, and how can it kind of bridge the valuation gap compared to the peers?
Yeah. So currently, Lightspeed is at 42% payments penetration, and we have it going up to 60% at our end of our forecast period at 2035. This 60% was based on management guidance that they expected to get to 60% as a natural ceiling for payments penetration over the near term. And so for the basis of our model, we assume 60% payment penetration by 2035, as compared to peers such as Toast, where they have higher payment penetration in the range of 90 to 95% compared to Lightspeed.
You mentioned them not having as much of the value chain as their competitors. Is it possible to acquire and close that gap?
Yeah, so the main reason why Lightspeed decided to use Stripe instead of building a lot of that payment value chain in-house was so that they could expand into different geographies more quickly. And as a result, we think it'd be actually difficult to leave Stripe and actually build it in-house or acquire another company, just given the fact that a lot of their current infrastructure, for example, Lightspeed Payments and their e-commerce solutions, are built on that Stripe infrastructure.
To quickly add on, through our conversations with a senior engineer at Fiserv, we heard that in order for Lightspeed to further integrate into the payments value chain, it'd be very difficult for them to find a target that has the needed infrastructure. For example, the engineer at Fiserv highlighted that in a single transaction, it hits as many as 20 different players. So for Lightspeed to find a smaller company that they could afford to acquire, it would be very difficult for a target like that to occur.
Thank you for the presentation. So in terms of your forecasts going forward on revenue growth, are you assuming it's organic or is it from more acquisitions?
We are forecasting our revenue growth purely organic because management has stated that they are moving away from this inorganic strategy. They're no longer looking to do acquisitions. So revenue growth is mostly driven off of subscription revenue growth as well as transaction that's built off of location growth.
Maybe just a quick follow-up. So if they then switch from organic growth and not acquisitions, which is destroying value, does that then change your assumptions around margins going forward?
Yeah. And so the assumption with pursuing organic growth aside from inorganic growth impacts margins in a few ways. Firstly, in terms of the acquisitions and integrating all of these, we think that historically they had to spend a lot on these acquisitions and integrate them. However, going forward, they will still have an impact to margins as there's a large sales and marketing cost included with pursuing organic growth. Lightspeed will have to hire more sales reps, expand into new markets, especially in this competitive POS industry where they'll have to go and acquire customers with these sales force. It will still be quite expensive and dilutive to margins on the sales and marketing front.
Can you explain a bit more on the valuation why you pick 80% weight for DCF and smaller weight for valuative comps?
Yeah, so the key reason is we don't think peers are an accurate representation of Lightspeed, as for one, a lot of peers are significantly larger than Lightspeed, so greater economies of scale, and don't have the same problems Lightspeed does. For example, they're more integrated in the payments value chain, and they have a more cohesive code base and better product than Lightspeed.
I noticed the hardware margins were pretty negative. Is that structural, and is there a way to change that?
Yeah, so that's a structural issue with the industry where in order to gain customers, companies typically discount their hardware, 70 to 80%. We had the opportunity to have a sales call with a Toast sales representative, and the quote that they gave us was around 70 to 80% discount on the hardware margins, and then a Lightspeed sales representative gave us a similar discount on hardware.
And in addition, maybe just to add on the idea of further upside by increasing these margins, the hardware segment is only 3% of their revenue. And as of now, they're shifting much more to be a payments dominated players. So most of their revenue should be focused on the transaction based segments.
And you mentioned that they're not as good in the online area. How do you compare them to peers at this point, and what do they need to improve to get to the point where they're competitive?
Yeah, so an important piece of context on Lightspeed's e-commerce offering is that they actually built it through acquisition. It was one of their last acquisitions, and they were unable to successfully integrate it. Through conversations with merchants that have tried to use Lightspeed's e-commerce offering, they state that even though they use the Lightspeed point of sale in their retail store, it's not immediately updates with what they have on their e-commerce offering, and there's issues with syncing between the two different products. In comparison, the largest threat in terms of an e-commerce player in the space is Shopify, which has been very successful and has had much more positive reviews from customers. Additionally, we actually came across some merchants who do use Lightspeed point of sale for their in-house retail, but the e-commerce offering is so poor that they actually also use Shopify and would rather maintain two different systems rather than using Lightspeed's e-commerce.
So, what specific metric or event will cause the stock to derate? And what would be one thing that you would recommend to the management for a change?
I can take on the first part of the question, which is talking about what we think will cause stock to derate. So there's two elements to it. The first is that we believe that the market is giving too much credit to Lightspeed's growth strategy, which we believe that they will fail to execute on, given our conversations with merchants, customers, their poor historical sales efficiency, and also just the competitive nature of the industry. The second part is that the market is actually still valuing Lightspeed majorly as still a software player. However, Lightspeed now is shifting more towards similar to pure play payments players, and therefore the market is expecting, for example, EBITDA margin expansion from R&D efficiencies. But through our conversations with former engineers at Lightspeed, as well as ones at other pure play payments providers, we believe that this is unreasonable and margin expansion at this degree is not possible for Lightspeed.
And to address the second part of your question of what we would recommend management to do to help turn around the business and improve its forecast going forward, we believe that the strongest thing management could do is to integrate all of their products together and to create an overall better product that can go out and offer to merchants. However, one key thing to note with this is that through our conversations with merchants and what a lot of industry experts echo is the fact that the buyer of these POS systems are factor in a lot of word of mouth and referrals and recommendations. And so reputation is a very important thing in this industry. For example, restaurants or retailers that have used Lightspeed in the past and had a bad experience are unlikely to switch to Lightspeed even if they perfect their product and improve significantly from what they are now.
On your slide on investment risks, you had a comparison of the margins versus the consensus for 2029. You're expecting their margins to drop by 100 basis points, while the consensus is an increase of 300 basis points. That's a quite significant variance. I was wondering what the difference is between your expectations and the market.
So part of that is associated with the fact that the market is still somewhat viewing Lightspeed as a software business, and the software sector of their business has had some improvement in gross margins. However, it's important to note that there's a fundamental mix shift occurring with Lightspeed, where they're shifting more and more towards this lower margin transaction-based revenues, which are fundamentally different from the software side of things. So that's kind of where some of that delta occurs, where we're forecasting the continued mix shift towards transaction-based revenues, which are lower margins, resulting in a decline, whereas Street is still expecting some further efficiencies to be unlocked, which are typically associated with a more software type business.
What do you think in terms of just upside surprise versus what your assumptions are? What's the biggest risk to your assumption that the stock could outperform?
We believe that one of the biggest risks would actually be a management change. So, for instance, when looking at the current CEO and former founder Dax Silva, he was actually initially appointed as an interim CEO in 2024. However, we believe that this is unreasonable for it to happen due to a few key reasons. The first is that while they were searching for a new CEO during the time he was away, nobody stepped up. And he also owns around 10% of the company right now, which will make it difficult for him to let go, as well When we think about the board, we think that something that could be an upside change would be switching out some of the members and just integrating more payments expertise that would give a stronger conviction that they can truly execute on this new strategy.
What would you say is the reason for the variance between the fact that the market expects the higher margin side to grow and the fact that the company is trading below the market in terms of multiples?
Yeah. And so in terms of why we think the market is still viewing Lightspeed as a software business and Lightspeed is trading down, when we look at some articles where we look at what research analysts are assessing Lightspeed on and the companies they compare it to, they actually benchmark them to primarily software names. Reconciling that with what is currently being priced in the market in terms of its multiple now, while it is at a depressed valuation relative to peers, the market still believes in terms of some slight upside in the near quarters in terms of location growth, which we believe will not happen due to the expensive sales and marketing and overall limited white space in the overall industry, alongside margin expansion, which will not occur due to the fundamental mix shift and the structural issues in the operating expenses with Lightspeed in terms of sales and marketing and the R&D expense from the acquisitions.
Their recent third quarter results showed GP improved to 43%, but you forecast the um, margin to drop another 100 bips going forward. And they also raised guidance, right, for the full year. So what specific assumptions did you reject from the management on the earnings call?
Maybe just to put some other color into the earnings call, while they did raise guidance on revenue, they actually lowered and tightened the margin guidance, which is why the stock had reacted negatively on the day. And this is also still a little bit short of their full long-term guidance, which is the one clear one that we are basing many of our assumptions on.
And touching on the gross margin point, the reason that they were able to grow gross margins up to 43%, aside from the mix shift points that we discussed, is the fact they were able to raise pricing on the subscription side, where when they did, there was some negative chatter in the industry about, but they still were able to receive some temporary gross margin benefit there from raising prices on the subscription side, which we view as unsustainable and unlikely to happen going forward, especially as the industry gets more competitive.
What is the probability or your likelihood that this company can turn into a multi-product fintech rather than just a payment solutions company?
When we look at the idea of them being multi-product and really being an all in-house suite, that was actually the original thesis behind their acquisitions. The idea is that they would acquire a few different microservices and then be one all in-house platform. However, it's clear that that hasn't occurred, with many merchants saying the issues with integration and having this idea of an all-in-one suite. In comparison, peers such as Toast have continued to push out new products and new features in-house. For example, they now offer advertising capabilities and drive-through capabilities to their users. So originally, we see that it would be difficult for Lightspeed to achieve this all-in-house suite. And even if they did, their peers are already doing it and would already be ahead of them.
Why do you think they had such a hard time finding a new manager or a CEO? And at this point, the founder, it sounds like he needs to leave and find a new CEO. Um, is there anybody that comes to mind?
So just to touch on the first part, perhaps on why it was so difficult to find a new CEO. For one of the things to note is that current founder, the current CEO, Dax Silva, does own 10% of the company, and he also used to have these super voter shares. In addition, we believe that the board itself is part of the reason because they lack the payments expertise. They don't have the expertise to place the right CEO on the company. When we look at the board tenure, it's also quite short, and they've been changing out new members, but we believe still not bringing in the right people.
And to touch on why they wouldn't be able to bring in a new CEO, we think it's helpful to add a little color on what happened previously. When Dax first stepped down, they appointed their previous president to take over and run the business. However, when he took over, the business continued to miss guidance and lose out on profitability, where they then reinstated Dax Silva. Going forward, we believe they have a hard time finding a new CEO, which is backed up by some of the calls we did with former Lightspeed employees who were around when they were running a CEO search. They noted that it was hard to find someone who would come over and help fix around Lightspeed, as they saw that it would be incredibly difficult to help integrate all the acquisitions, achieve payment profitability, alongside all the other issues within Lightspeed. And we think this is also backed up by previous management changes that have happened, as they recently saw their president leave, which was a key driving factor in some of the good parts of Lightspeed previously. And they've replaced them with another software go-to-market lead that had limited experience in payments and POS systems going forward.
So your thesis is basically that the business model is fine, but the management is not doing what it should be doing. Don't you think it could be a perfect case for an acquisition by a competitor?
So I think on the topic of the business model, we do have some issues with the structural product standalone compared to peers in the space. And then when we think about the industry as well, the idea that it's reaching a growth ceiling and that there's limited further upside for the industry and new customers to be taken, especially following the already
Just want to take 1 second to congratulate all of you. I was blown away by the thoughtful analysis and the teamwork and just the really great job on behalf of all of the teams. Congratulations. Very well done. All right, the winner of the 2026 Research Challenge Global Final is the University of Waterloo.